All right, so good morning, everyone. Welcome to the end of the week. It's Friday, July 18th, 2025. Recording this at about 7:20 in the morning. Okay, let's have a quick look. We had a speech sort of last night from Waller. It's quite interesting looking at this because essentially it's a very, very dovish speech, and it seems clear that Waller is auditioning for the job to take over from Fed Chairman Powell. So this is almost like a speech delivered directly to Donald Trump's inbox. But nonetheless, it is quite an interesting sort of view, just because it presents the dovish case for the Fed for cutting. And in fact, you see at the very first line, he says, "My purpose this evening is to explain why I believe the FOMC should reduce our policy rate by 25 basis points in July, so at our next meeting." And almost no one else is saying that, so he's being extremely dovish here. And it's worthwhile reading. It's on the Fed's website. And basically, one of his, it's sort of two main points he makes. You see here, tariffs are a one-off increase in the price level and do not cause inflation beyond a temporary surge. So essentially what he's trying to say is that central banks historically, that's the whole concept of the core measures, which exclude food and energy, which are very, very volatile. He's essentially saying that one of the core principles of central banking is that if something is a one-off move, it's not an inflationary tendency. It's simply a price increase, and it's not, in a certain sense, inflation, in the sense that it's not an ongoing sort of psychological sort of process which causes people to want to have more money and more wages because prices are constantly rising. What he's saying is that tariffs will cause probably a price rise, but that's the price rise. And then he goes on to other sort of explanations to also say that people might change their consumption, and eventually it might actually lead to a slowdown, and therefore actually which would be disinflationary. So it's worth reading just for a sort of a relatively well argued sort of very, very dovish case. But we can't exclude the fact that it is probably very political as well. So we have to assume that Waller in July, which is only a couple of weeks away, will be voting for a cut. I don't think anyone else will be joining him there. The second thing which Waller says, one of the other main reasons that he's sort of dovish, is essentially saying that in his view, there are significant cracks starting to slow up in the employment situation in the US, in the labor market, and he believes that the Fed should not be behind the curve and shouldn't wait too long, and should because the labor market is actually sort of pausing, and maybe even will sort of slow down quite soon. So it's a little bit of a negative case on the economy. He does believe the economy is going to slow down a little bit. The price rises will be sort of a temporary and one-off, and will not be sort of long inflation. And he believes that the labor market will weaken. So that's kind of interesting. Now, if you actually think what the market's thinking about this, the market doesn't really agree with him, and I think everyone's sort of assuming that Waller is just acting very, very politically and trying to, as I said, audition for the job to take over from Powell. And so if we actually just see just quickly what's going on in the US interest rates probabilities, we can see that just again for July. So even if Waller says that he will be voting for a cut, it seems that no one else on the Federal Open Market Committee will be joining him. And you can see only 1 basis points out of 25 cuts are priced in at this point. So only a 4%. So basically sort of a 0% of any of the Fed as a totality cutting. What's going to be interesting is just to see what happens. We had the data yesterday. We had retail sales, which were, all things considered, quite robust, pretty solid. There's a few little details, but overall, in my interpretation, fairly solid. We also had initial jobless claims and continuing claims yesterday, which continue to point to a very, as I say, a very solid or robust labor market. So at this point, it looks as though the US consumer is doing okay. The labor market is solid. Now, of course, you can always point to things here and there about increase sort of home foreclosures and delinquency rates on subprime car loans and credit card late payments going up. There's definitely some stuff happening, but the issue is that just at the lower percentile, lower quartile of sort of income earners, as in fact the great majority, the vast majority of American consumers are doing sort of okay. Although people, yes, maybe are sort of worried or concerned or confused about Trump and his economic policies and the tariffs, but the reality is that the American economy economy does seem to be chugging along at this point. So all that to say that there doesn't seem to be any particular hurry for the Fed to cut. I mean, despite all the political pressures, and we're seeing that's being reflected in what the market's perception is. You can see here now for the September meeting, only a 63% chance of a cut. So not a full cut, only about 15 out of 25 basis points priced in. And by the end of the year, we now have 1.8 cuts. So that's a little bit lower than the two, which we've seen a lot over the last, let's say, a month or two. So we're still hovering just under two, just over two cuts. But I'm just wondering if we continue to get a sort of solid labor market and sort of any more evidence that prices are starting to go up because of inflation, continuing or not, or permanent or not. And I just wonder whether the September cut, this 15 basis points might sort of slowly bleed down to 12 basis points, 10 basis points, 9 basis points. So that's an interesting potential trade there, if that's what one's view of maybe sort of shorting, Fed funds rate futures for September, or maybe even the September SOFR contracts, because it seems to me that there is a reasonable chance here that 15 basis points of cuts could be priced down by at least like 5 or 7, could be halved, maybe down to sort of 7 or 8 basis points or something, if the data cooperates. Okay, so I'm just going to grab some tea here. The other interesting thing just to keep in mind here, I'm just going to bring up a chart here of the 30 years. We have in Japan on Sunday, we have the election for the upper house. So not the lower house, but the upper house, almost kind of like the Senate. And just interesting here, let's just have a look. This is 30-year yields around the developed world. And you can see here, here's Germany in the blue. You see, now what I've done here, I've normalized this back to sort of essentially the beginning of November here, when Trump won the election, although of course he didn't take power until January. But what you can see is that overall 30-year yields have risen all over the developed world, but especially, let's say, in Germany. But I also just want to bring your attention, guys, to Japan. So there's the Japanese 30-year yield. And you can see here that there's kind of this sort of apricot color. And you can see here that that's actually gone up on a comparative basis. Again, this is normalized. This is not a price. This is kind of a normalized comparison. And you can see that the 30-year yield has gone up a lot. Now, the implications for this are important, because if the Japanese 30-year yield is going up, it's one of the world's largest bond markets. I think outside the US, it's second largest in terms of scale, and that will have a spillover effect onto yields in other parts of the developing market. Now, the whole point is that on Sunday, as I just said, we do have the election for the upper house. And as people who follow Japanese politics know, the LDP, the Liberal Democrat Party, has been the dominant party there since the US stopped their occupying in Japan in the late 1940s. So it's a very sort of stable political scene. And at the moment, there's sort of a coalition, and so the current ruling coalition, though, it may not secure a majority in this election. And at the moment, it's ruling with a sort of a smaller party, the Komeito. And the idea here is that there's a reasonable possibility that Japan that coalition may not hold. And if that's the case, it could put political pressure on the prime minister, Ishiba, basically to resign. And the reason this is important, I just want to sort of look at something here as well. This is the Japanese yield curve. And you see here that it's pretty healthy. It's just a nice sort of upward sloping curve. But if we go back, let's say 12 months, just to put the scale of the change, and I'm just going to show you 12 months ago, you can see that all across the curve, but especially going into the long end, look at where the yields have risen the most. So you see here the 15, 30, even they have super long bonds, 40-year bonds here. They've risen a lot. You're talking, what are we talking here? 70, 80, 90 basis points. So there's been a big run up in the bond yields. And that's potentially sort of an issue. So what I want to bring up here as well is just to have a quick look here at the Japanese yen chart. And the problem here is that, as you can see here, the US dollar has been grinding higher against the yen. You can see all these moving averages slowly sort of turning, they're flattening out, and even the 20 and the 50 are starting to push upwards. And now we have the US dollar breaking out above, the 200-day moving average at about 148 here. And so the thing is that what a lot of commentators are thinking, and analysts, is basically if we get some sort of shock to political stability, which means that the LDP Komeito Komeito coalition does not survive this Sunday, we could have some significant moves upwards. On the other hand, if they do, there could be also just a case for US dollar just sort of backing off and the yen coming down here. So I was doing some research and I came across quite a nice table here, which gives a nice little summary. And one thing to keep in mind here is as well just the politics of all. If you look at core inflation, so you see core inflation here, there's the headline sort of sort of stabilizing downwards. But this light blue line here is the core inflation in Japan, which is going up and up. So the point here is that the BOJ is, potentially going to be sort of hiking at some point in the next meeting or two. At the moment, they've held off because of the negotiations, the delicate negotiations with Trump on tariffs. But the idea is here, if this core inflation pressure continues to rise, this could, really put quite a lot of pressure on the BOJ, the Bank of Japan, to hike interest rates, which of course will put upward pressure sort of on the yields. And the thing here, so that's something which is kind of a factor. So if we look here and say the LDP keeps control, so that's the status quo at the moment. So basically they retain their slim majority, and that means that the prime minister will not have to resign, and so there'll be continuing stability. And then potentially, as it says here, the BOJ can normalize one day, which means to hike interest rates. So what that means there is that's probably going to be a positive for the Japanese yen. So basically, that means political stability. They can continue negotiating with Trump on the tariffs, and it also gives the political sort of stability and context, which will enable the BOJ to potentially sort of hike. So that, according to this commentator here, down 400 pips on USD weakness, so Japanese strength within a couple of hours. Maybe, I don't know, that seems like quite a big move, but I guess it's possible. The other thing as well, just as a context to keep in mind here, is that a lot of the opposition parties, there's a sort of a Japan first opposition party, sort of more on the right wing, and there are some of these opposition parties during the election cycle have been promising to cut taxes. So again, that's more sort of fiscal ill discipline and more pressure on borrowing costs and whatnot. So a bit of populism. Now, the point is that if the LDP keeps control of the upper house, that will no longer be on the table. So therefore, less issuance, which is, more of a better stable situation. So let's say a narrow majority or slim loss. So the coalition loses seats but forms an alliance. So the status quo, but sort of weakened. It could be, more fiscal, less BOJ. So more fiscal here, the idea, as I was just saying, is that there'll be more political pressure from sort of non-LDP political parties to basically, sort of cut taxes, raise spending, improve the social welfare net. And therefore, that is not going to be great for the Japanese yen. So saying here, USD could actually go up, a couple of percent or whatever. And let's say if the LDP completely loses, there's a political sort of flip here, and that this ruling coalition loses, saying outright. That's going to be interesting here. They're saying that what would there be? The USD would strengthen significantly. Some people saying even up to 150 or something like that, just because the BOJ, they probably won't be won't be hiking anymore. More fiscal sort of stimulus, as I was saying, and election uncertainty. And of course, the idea here is that if there's political uncertainty, that means that the negotiations with Trump and the tariffs would probably be put to the side again, which is not great for stability, which is a negative for the Japanese yen. So all that to say that it's quite interesting times this Sunday over in Japan in terms of their domestic politics. As I say, it's not for the lower house, it's for the upper house. So just keep an eye on that. And what you want to do is to simply that, probably what's going to be sort of Japanese yen positive is going to be the status quo. So the ruling LDP coalition winning. On the other side, if they have a significant loss, that would be pretty negative for the Japanese yen and up for the US dollar. So that's definitely something to look out for. Okay, guys, I've spoken a little bit too much. Not a huge amount else coming up. We have the ECB next week. Let's just keep an eye on sort of equities. Where are we? So see the equities. They look. I mean, if you look at the VIX here, volatility very, very. I don't want to say super sleepy because the point is it's not at 12 or 13. So it's at about a 1% sort of a daily sort of level. So about 16% annualized here. So that's all things considered, that's a positive for the ES. And you see here the ES. It's in this sort of pretty sleepy sort of summer sideways range. But I'm just saying that this chart is bullish. You look at all the trend lines here; they're still pushing upwards. You could argue that it's a little bit overextended. Some of these Fibonacci extensions have drawn out with possible targets up here. But you can see here that we've had this sideways consolidation. So probably not as overbought as it had been. And this looks to me as though this is almost like a sideways consolidation bull flag. If you like that kind of thing, is a consolidation, which could be sort of pushing outwards. I just saw we had American Express earnings. The earnings have been, relatively solid. Let's have a quick look. I didn't have time to have a good look because they just came out. But from what I can just see from the headlines, see American Express um, earnings per share, 4.08, estimated 3.87. So on the face of it, that looks, relatively good. Schwab average trades, that looks okay, Charles Schwab. So the point is that the earnings seems to be going, relatively well at this point. The Fed in one shape or another is not going to be hiking rates. At some point, the market knows that they will be cutting. The tariff situation, the market seems to be getting comfortable, either sort of ignoring the tariff negotiations or essentially saying that, in some shape or form, they'll settle in at, +5, +8%. And really, there's going to be sort of a squabbling amongst who will have to pay that. And will it be sort of equally shared between the four main constituents, which is like the US consumer, the retailer, the wholesaler, and the exporter or the original producer? And that's, by the way, that's what Waller is saying. If you read his speech from the Fed, he's essentially saying that, it may not be such a disaster and so inflationary because essentially the costs of the tariffs will be ultimately the market will make sure that they're spread over the four main sort of interest groups in a sense. Okay, I'll leave it there, guys. Not a huge amount happening today. We have a little bit of we have the University of Michigan. The problem is that this seems to have become extremely politicized and partisan, in the sense that Democratic participants or respondents, there's the word, respondents who identify as either Democrat or Republican are having very divergent views on where inflation is going and expectations. So the market is not looking at this too much. So I'm not going to talk about it too much. We have building permits and housing starts. Let's keep an eye on that. Just because Trump has also been hammering the Fed for many reasons, but one of the reasons is saying that the Fed is destroying the housing market because they're keeping mortgage rates, long-term interest rates or interest rates high, and therefore sort of mortgage rates, which of course are based on the 20 and 30-year bond yields. And I think even this morning Trump was hammering away. Here we go. Trump comments in a post on the Fed and the housing market. Okay, guys, so I'm going to leave it there. Have a great sort of Friday and weekend, and we will continue this next week, of course. Thank you very much, and have a great day.